Hello, I am Eric Mancini, CFA, CFP, Kaya, and Director of Investment Research at Trapegan CPAs and Wealth Advisors. Thanks for joining us. This afternoon, we're going to be looking at rising interest rates and how it impacts portfolios, financial assets, and it certainly has been in the news lately. And we have experienced a pullback, especially in certain sectors of the market and in bonds in relation to rising interest rates. So very topical to discuss. So what we're going to go over specifically today is looking at short-term and long-term interest rates, understanding the differences, who controls short-term and long-term rates, and what they impact. We're going to look at why interest rates matter in determining the value of almost all financial assets, and one of the most important factors. We're going to look at Trapeg and how we anticipated really a year ago rates starting to go up in March, April, May of 2020, and why we think this will probably continue as we move through 2021. We're going to look at historical, nominal, which are the rates that you just look at, the actual rates, and then real Treasury rates, which is important as well. And real Treasury rates is the Treasury, the rate you get on a Treasury bond minus inflation. And those could be negative or positive. Right now, they're negative real rates. And then lastly, we're going to look at the portfolio changes we made over the past year, and then some more possible changes we're going to make in the future to guard against future rising rates. So we'll start off with short versus long-term interest rates. So short-term rates, these are under the direct control of the Federal Reserve. So there's very little market input in here or market impact. These are basically just set by the Federal Reserve. And, for banks and the economy, this is the rate which banks charge each other for overnight liquidity. That doesn't mean too much for most individuals. What really matters more is these are what controls what returns you get on CDs, savings accounts, and other deposit accounts. And that's where these come in. So right now, the Fed Reserve has stated that we're going to keep short-term rates at zero. That's where they are, or just above. And that's why on CDs, savings, and other deposits, money market accounts, things like that, basically you are getting 0% and probably will be for at least another year or so. And these are bonds with maturities of less than 1 year in general. Now you go out further, so longer term bonds, mid to long term, and these are not controlled by the Federal Reserve, at least not usually. These are determined by the free markets. So it's thousands or hundreds of thousands of investors buying and selling the bonds with all types of expectations built in. So inflation, economic growth, recession fears, time preference, all that is built into the aggregate market. And the market overall dictates these rates. And these can go up and down, obviously, through time. And these are very important as well, where the 10-year Treasury is really the benchmark, and that dictates mortgage rates, personal car loans, and also in valuing all financial assets. So real estate, stocks, bonds, you name it, almost all financial assets are impacted by interest rates. And these are bonds with maturities of 5 to 30 years. Now, getting to why rates matter in terms of asset valuations. So this slide goes back to 1980 in the box to the left. And when you look at it, the 10-year Treasury rate at that point was 14%. You could get a risk-free, guaranteed by the US government 14% per year for 10 years. That obviously seems like another world at this point, but that was what the 10-year yielded back then. And on the S&P 500, if you were in the stock market, you got 5.1% in dividends alone at that point. And the valuation, we look at something called earnings yield. And earnings yield is if you take the earnings per share of a stock and then divide it by the stock price, it gives you a percent. So in this example, if a company earns $1 and the stock is trading at $7.25, you take the 1 divided by 7.25, and it gets you 13.8%. What that means is you basically look at that 13.8%, you can compare it to bonds, and you were in a pretty good position in 1980 if you were trying to get investment returns. You get a 14% on treasuries, or you could get an immediate 13.8% earnings yield on a stock with a 5.1% dividend yield and growth on top of that with stocks. Now, fast forward to 2021 and what effect that has had on, the difference in interest rates and what effect that has on the stock market. So right now, we are sitting on 10-year treasury rate of 1.6%. The dividend yield on the S&P 500 is 1.5%. And when we look at that same valuation, so if we're using the same type of, average earnings yield on the S&P currently, it is 3% earnings yield, which means that same stock in 1980 that was earning $1 but trading at $7.25, still earning $1, but now with current valuations, it is trading at $33.30. And when you do the math again, you take the $1 in earnings, you divide it by 33.3, the stock price, it gets you to 3%. And that's roughly the current earnings yield of the S&P 500. So as you can see, as interest rates go down, as the risk-free rate goes down, the amount you're willing to pay for a stock or real estate or anything else goes up because it forces, forces those valuations to come into alignment. And if on the flip side, what we're going through now in the last couple of weeks, as interest rates go back up, obviously nowhere near to where we were in the 1980s or 90s even, but even just a little bit, it will force stock prices down to some extent to realign the relationship to bonds and stocks. So it's really very important. One of the most important things, evaluation, is interest rates. And as we look at where we think rates are heading from here, we do think they are going higher. And this is a chart looking back over the past 5 years of the 10-year Treasury rate. And it's really averaged for the most part, except for the pandemic period, between 2 and 3% for the most part. And that is where we think it's headed. So right now we're at 1.6% or just under. And we think it's going back up. And that's a significant move. We think it's going back up for a couple reasons. One is mainly the reopening of the economy. So vaccines seem to be working. States are starting to really reopen, some fully, and we think that continues. So we have a growing economy, a reopening economy, lower unemployment, hopefully. And then on top of that, we're putting a lot of stimulus onto the economy in the form of unemployment payments, stimulus payments, payments or support to states and businesses, and then maybe an infrastructure bill as well. So that is a lot of fuel to the fire coming into the economy, which is all good. But along with that will come higher inflation and we think higher rates. So back in about a year ago, March of 2020, April 2020, going forward, we began to see that prospect increase. So even starting in March 2020, a full year ago, we began to trim bonds and other interest rate sensitive securities a full year ago, and we continue to do so through today. We made additional trades over the last couple months and a couple to go, most likely, over the next couple weeks or months as well. So we really have taken a lot of bond or interest rate exposure out of the portfolios over the last 9 to 12 months already and continue to look to do so. Here, again, is just a look at another way to look at rates. So this is real interest rates from 2003 through 2021. And what real interest rates are is you take what you get on the 10-year Treasury. So right now, the 10-year Treasury, as an example, is yielding 1.6%. You minus off inflation. So inflation now is about, depending on how you measure it, about 2% or so. So 1.6 you get in interest from a Treasury, you minus off 2% inflation, that gets you negative 0.4% real rate. Negative real rates really do help stocks, real estate, other types of financial assets go up. Because if you just hold cash or treasuries, things like that, you are losing money every year to inflation. So it forces people into other assets. And this is a chart going back as normally there is a positive a positive real interest rate. And that's what we've seen for the most part from '03, through last year. But during the pandemic and for a brief period of time in 2013, we did see negative real rates. And that does cause a real push into risk assets. We do think as rates come up, we'll probably get back into that target area, which is somewhere between about break even or 0% real interest rates and maybe upwards of 1%. And that will have an impact, and that's what we're seeing on the stock market as we speak. And briefly, this is just a look at the 20-year chart of the 10-year rates. And you can see going back to about 2000 or 2001, it was as high as 5%, 5.5% at that point. And then really we've just been in a pattern of a stair step down since then. So the period of 2000 to 2007 before the '08-09 crash, it was averaging 4 to 5%. And then from that point, from the '08-09 crash to the pandemic, it was averaging 2 to 3. And we'll see. We think we're going back to that 2 to 3% general range. And then just really looking at the pandemic impact and more recent moves in the rate. So we were at, as recently as the tail end of 18 and the beginning of 19, about 3% on the 10-year. Then there was a gradual decline throughout 2019, and then a rapid decline when the recession hit and the pandemic hit in March. And it got as low as 0.4%, the lowest on record. And then what we've seen since the fall of 2020, and especially early in 2021, is a rapid recovery in rates as we're coming out of the recession. And we think that, again, continues somewhere in the low to mid 2% range. And then lastly, when we look at what we have already done in the portfolios to guard against this, and again, all these changes were made between March of 2020 and up to a couple weeks ago. Some of the earlier changes we made were eliminated TIPS, which form of treasuries. They do have an inflation aspect to them, but they still are very interest rate sensitive. So we eliminated those 100% in March, April of 2020. And depending on the risk level of the portfolio, we either fully eliminated 100% treasury bonds and investment grade bonds over the past year, or the more conservative portfolios, a significant trim of 35%. And we continue to look for ways to trim out of treasury bonds and investment grade bonds without increasing risk of the portfolio or the volatility. And in place of these investment grade or treasury bonds, we look for alternatives. So what we did, one of our newer alternatives, middle market lending fund, that is not interest rate sensitive, secured loans to private businesses. We get about 7% interest on that, very low volatility, very low historical default rates. And we also added additional allocations to our alternative lending sleeve, which we held for years, and also insurance securities, which we've held for years. And in both of those areas, we see pretty solid fundamentals in terms of current yield and increase in prospective returns. For instance, for alternative lending, we would expect about 5 to 6% per year in yield. Insurance securities, total returns, given normal type of activity with natural disasters and hurricanes, of mid to upper single digits. So much more potential return in all these sectors than traditional bonds with no interest rate sensitivity. And on the bond allocation that we kept, we reduced the duration. So we brought the maturities of the bonds down from longer to shorter, and that also reduces interest rate risk. More recently, what we did, and it's not as obvious, but growth stocks, highly valued stocks, tech stocks specifically, those are also very vulnerable to higher interest rates. So we're still overweight technology, but we did trim it. And in some cases, eliminate certain securities that are very sensitive to interest rates. So that would be ARKK and IGM. And we did that over the past couple of months. And that has certainly helped, especially with the pullback we have seen over the past couple weeks in technology. And with those trims, we've added to small cap stocks, value, and cyclical stocks, which are either not impacted or actually in some cases positively affected by rising interest rates. Some of the few areas that are helped by rising interest rates would be financials, banks, energy, industrials, things like that. And that makes up a lot of the small cap sector. And lastly, we'll finish off with what we might be doing in the future, in the near term, to further guard against rising interest rates. There's a fund that's a combination of inflation protected Treasury securities and rate options that really guard against, while still getting a good income, guard against rising rates. Whether they go up or down does not matter. This hedges that risk out and you just get an income. So we're looking at that as a possible addition. We're looking to further reduce Treasury investment grade bonds for conservative investors who still have them where possible and use alternatives in their place. And then two groups of stocks that are not interest rate sensitive, one being pre-IPO private companies, which don't really move in relation to interest rates at all. Very low volatility sector of companies. And the other being stocks that specifically benefit from rising rates. So again, these would be banks, especially regional banks, energy companies, infrastructure, things of that nature. And through all the portfolio changes we are already put in place over the last year, plus these possible changes in the near future, really protects the portfolio. And as always, thanks for joining us. I hope you got something out of it. And any questions, please, contact your Traphagen Wealth Advisor, or you could contact me with my email at the bottom, Eric, ERIC, @tfgllc.com. Thanks a lot, and have a good weekend.